Thank you. We now move on to item 2, public comments. At this time, members of the public may address the Board of Directors regarding any items within the subject matter jurisdiction of the Board of Directors, but no action may be taken on off-agenda items unless authorized by law. Comments shall be limited to 3 minutes per person and 20 minutes for all comments unless the chairman, subject to the approval of the board, sets different time limits. Do we have any requests to speak this morning?
No, we don't.
Great, thank you. We now move on to our consent calendar, items 1 through 5. Okay.
Second?
We have a motion to approve and a second. All in favor? Yes,
Aye.
Director Murphy?
Yeah, I need to record an abstention on item 5, that would be report number 13 due to a potential for conflicts based on employment.
Okay. You want to pull 5? Okay.
Move the balance, less
Second?
Mr. Chamberlain?
I'd like to request a change to the minutes. Sure.
Okay, so we'll pull item 1 as well.
Okay, how about move items, all items excluding William?
Correct. We have a motion and a second. All in favor?
Aye.
All opposed? Okay. We'll now move back to item number 1. Mr. Chamberlain, would you like to comment?
Right, so page 8 of the minutes refers to Mr. Bernera's statement that the department cannot convert a general purpose lane to an HOV lane. The department can convert a general purpose lane to an HOV lane. What we are precluded from doing is converting a general purpose lane to an HOT lane, high occupancy toll. That's paragraph 3.
Okay, we'll note that change. Thank you.
Madam Chair, I'm sorry, but from this angle, I can't hear you, Ryan. Would you mind saying that again?
James Panero had responded in the minutes that the department is precluded from converting a general purpose lane to an HOV lane, high occupancy vehicle lane. What the reality is the department can do that. We cannot convert a general purpose lane to a high occupancy toll lane. So it's a distinction between an HOV lane versus an HOT.
So we're just correcting the minutes to reflect that.
Okay, thank you.
So can I ask a question?
Yes,
Madam
Director
Chair?
Spitzer?
Did Mr. Pinero say that? Did he use the word HOV, or we're not sure?
I didn't have the audio. I'm assuming he knows that we can convert a GP lane to an HOV. If we're precluded from a GP lane to an HOT. Without hearing the audio, I can't confirm.
Okay, I don't want to be hyper-technical, but you can't change minutes because you want to, right? It's because it has to be more, the accuracy. So I would suggest that you leave it if it hasn't been confirmed. You just footnote it and just say, it's a footnote that Caltrans Director Ryan Chamberlain indicated at the board meeting that you cannot, they only have the legal authorization to convert a general purpose to HOT. And then that way it's amended, but
I'd be fine with, I'd also ask staff to confirm on the audio if James did indeed say it correctly, that's reported correctly. He just stated it, it's just.
Maybe an option is, Madam Chair, is just simply
Yes.
continue the minutes till the next meeting. I don't know that they're time critical at this point.
Yes, because I think we'd like to review the audio.
good idea.
Okay.
Are you okay with it?
Okay, so we'll continue item 1. Now let's move on to item number 5. Director Nelson for comments.
Hi, thank you. Is this every computer for every staff member?
Hope not.
In the building, is that what we're doing?
Good morning, Jeff Bond, IT Director. What it is these are the computers that the corporate side TCA uses. We're not upgrading all the computers. Our call center, we're looking at a virtualized desktop environment for some of those computers. So we're only doing part of all the computers. There's roughly 120 to 140 more computers.
Okay, here's my question. We've got computers that are 5 years old. Some staff members have real intensive work. Maybe they're doing graphics, running, some complicated programs. But I ran a law firm. We had a lot of word processing, a lot of data storage. But you didn't just throw every computer in the building out and replace all of them at the same time. That just seems extraordinary. Some computers, yes, if they go down and you replace them 5 at a time, so that seems odd to me. The other was, I haven't priced this stuff in a while, but obviously Mac products are very expensive. These are not. We're paying over $1,000 a copy for kind of Microsoft Office and an IBM kind of compatible computer. That just seems sort of more than the average fool could walk into Best Buy and pick up a unit for. Can you help me out?
Right, we're paying for an industry standard motherboard, an Intel motherboard. that has a business life to it, 5 to 7 years. We're paying for an i7 processor, a faster processor than what you would normally buy on the low end things. 16 gigs of memory, so we can load those large spreadsheets and things like that in finance. And we're,
Right, but every employee doesn't work in finance. True. I realize you incur brain damage getting too finite, but, you have people, me, I mean, I sit at my desk at the county, I don't do the number crunching and things. I have very limited need for capacity. I basically send and receive emails. That's largely what my computer's used for. So,
okay, let me address the hardware. Over on the side, we have one of our old units next to the plant there, which is quite large. It's about 5 or 6 years old. That's one of the smaller units. What we're seeing now is it's difficult for us to get replacement parts. We've had a 4-year warranty on them. We've extended them 5.5 years. We're looking for a platform that is consistent. We can't really be assured that if we go into a Best Buy or whatever and buy, they're $7.99.
I'm not suggesting you go to Best Buy, but in a commercial application, my suspicion is if you're buying them 10, 20 at a time even, you're gonna get a better deal than going to Best Buy. That was the only point of my reference.
Okay.
I don't think you should go to Costco either unless you think it's a good idea, but you can get good deals.
We can, but why we've gone this direction is that when we do buy more computers in the future, we can get the same platform, so we can use the same spare parts, the same support. There isn't any bloatware on them, it's just strictly the operating system. So that's what we've done in the past, it's worked out well for us.
Okay, well, if we bought 85 today, next year, all of them are out of date, and and the parts start changing anyways, so having run a law office with 17 lawyers and all the support staff, the idea of changing out every computer in the place, because a couple of them were giving us problems and a couple of them always did, and we changed them out as we went. We tried to stick in within the brand so that tech people were familiar. But when 40 of them were still working and 5 were having problems, we didn't buy 45 computers because the other 30 of them might last another 4 years. And then when you replace them, you get even more life out of them. It just seems all too convenient to push the implode button and just clear the slate, throw every computer out, and buy 85 computers. But I understand that's the recommendation.
Yes.
Additional comments, Director Baker?
I also have a question. I thought it curious that Windows 7 was the operating system. Would you explain why we did that?
Sure. We opted to Windows 7 because it's a better fit for our business environment. Windows 8 comes with a Metro interface, but when we run any desktop applications, it drops down to the regular desktop interface that everybody's used to with Windows XP and Windows 7. It's a secure and mature operating system. Microsoft has indicated they'll support that operating system through 2020. So it made more sense for us to put a platform in front of our employees that they could just work directly on without a learning curve with a new interface, since it wasn't really necessary to have that interface in our business environment. Is that okay?
Yeah. Madam Chair, over here.
Oh, who's talking?
Down.
Sorry about that. Okay, Director Boyds.
Thank you. How many computers do we actually have with TCA and the staff?
We have
Approximately
approximately 90 computers.
90?
We have less than 90 staff, but we have some general purpose machines, like a computer that is running that display. Over in the committee room, we have a couple of scanning workstations as well.
So these are actually workstations throughout TCA?
Yes.
And how many bids came in?
We had 3 bids come in, but one, I have the PSR, sorry. We had three bids come in, and we went with the lowest bid.
Thank you.
Okay. Any other questions?
All right, if you want to take a look at the bids, they are 3 different bids on report number 13, last page. Okay, directors, any additional questions, comments? Do we have a motion?
So moved.
Second.
Okay, we have a motion and a second. All in favor?
Aye.
All opposed? Okay. If you could raise your hand on the no vote, please. Okay, Director Spitzer? Director Nelson? Okay. Are those duly noted? All right, thank you. We'll now move on to board business. Item number 6, if we could have a staff report, please.
Good morning. Gretchen Lindelof, Acting Controller. And the audited financial statements for the year ended June 30, 2013 are included in Report 10 of your board package. Today I would like to introduce Christopher Ray from KPMG, who is here to present the required communications.
Good morning. Thank you for the opportunity to present the results of our audit. There's some required communication we go through at the end of each audit, and so that's what I'd like to go through this morning. The financial statements that we audited, we issued an unqualified opinion on those financial statements, which basically said the financial statements were fairly stated in all material respects based on the results of our audit. We are required to perform the audit in accordance with specific auditing standards, and we did that because you are a governmental agency. That involves other types of standards we have to follow as well. As part of that, we look at the control structure within the organization, and then based on the controls that are in place, we determine what auditing procedures need to be performed, and that was consistent with how we performed the audit in the past. There are certain management judgments and estimates included in your financial statements, and as part of our audit, we actually look at those estimates and determine the reasonableness of those, and then determine our auditing procedures that need to take place. There's actually a footnote in the financial statements that notes that there are estimates included within the financials, and so that's just to highlight that for you. If we had any disagreements with management as part of the audit or difficulties encountered performing the audit, that's something I'd have to raise to your attention, that was not the case. If we had corrected or uncorrected audit misstatements that were identified as part of the audit, I would highlight those for you, but that did not occur as part of this audit. If we were aware that management consulted with another accounting firm, maybe on a difference of opinion or something that we had communicated as part of the audit, I would raise that to your attention. That did not occur. If there were significant issues discussed to be engaged as your auditor, that's something that I need to raise to your attention, but that was not the case. There are some communications that go on between management and our firm. One is an engagement letter, which dictates how our audit's going to be performed and the responsibilities of management as well as our firm. That was signed as part of the audit. And then there's also a representation letter at the end of the audit, basically saying that management agrees that their financial statements are fairly stated and they've disclosed and provided us all the information we need to complete the audit. So we received that as part of the engagement. And then last but not least, just want to confirm that we are independent as part of the audit. So I'd be happy to answer any questions that you have over the financial statements or questions about the audit.
Directors, any questions or comments? Yes, Director Spitzer.
Thank you for coming, sir. I want to talk about capital appreciation bonds, the
Okay.
CABs. Obviously, there's been a lot of discussion with respect to school districts' use of the CABs. Do you, and I'm sure you've been to continuing training in your profession now as a result of CABs using various financings. Do you have any statement about the use of CABs with respect to this particular audit?
No, I mean, the audit is designed to make sure that they've accounted for them correctly, as opposed to whether they, are appropriate based on your needs within the organization. But we did look at the bonds as part of the audit procedures and confirmed the information needed to basically disclose them correctly in your financial statements.
Thank you very much.
Directors, any more questions? Yes, Director Shea.
Yes, thank you. Just one quick question. I'm a little confused on the independent auditor's report on the second page. It's signed KPMG LLP. There's no signature. It looks like it's not even a stamp. Why is that like this?
That's our firm standard. You were engaging KPMG to perform the audit, and that they were signed using our KPMG signature.
It doesn't even look like a regular signature. It looks kind of funny to me, so I just didn't know if we're just trying to avoid really showing any commitment.
No, that's the.
It isn't weird. Maybe I'm wrong, but
No, that's just our standard signature that goes on every report that we issue.
Okay, so that's considered your official signature?
That is.
Okay.
Additional questions, comments? Do we have a motion?
So moved.
Second. We have a motion and a second. All in favor?
Aye.
All opposed? Okay, that item passes.
Thank you.
I'd like to confer with our legal counsel at this time. Mr. Joseph, do we have a need for closed session today?
Yes, Madam Chair, we will be conferring in closed session with legal counsel regarding anticipated litigation under Government Code Section 54956.95, subdivisions B and C. We do not anticipate reportable action.
Okay, at this time, I'd like for the Foothill Eastern Board of Directors to recess into closed session. Reconvene the Foothill Eastern Board of Directors meeting. If we could have Amy Potter to present the staff report on item number 7.
Good morning, Amy Potter, Chief Financial Officer. This report covers 2 items. The first is to amend the cooperative agreement with Caltrans that is necessary in order for us to pursue the refinancing transaction that this board approved in June. And the second is to approve an amendment to the resolution that was approved in June. And the reason for this is that some of the items in the original transaction have changed. When we brought the transaction to you in June, not all of the bonds were callable. So we had a tender offer included. We also had taxable and forward purchase bonds included. Those have been removed. We also are adding some options here that will allow us to enter the market today based on the current interest rate environment. So before I get into the details of those changes in the transaction that I'm presenting to you today, I'd like to take you back a little bit to June and talk about the reasons and the need for the refinance. And I know this looks like there's a lot on this slide, but I think I can just walk you through some very important points here. The blue bars that you see are the existing debt service, and it has a very steep growth rate and a very high peak debt service of $298 million. And the black line that you see right above that is the projected revenues based on our most recent traffic and revenue study. And what you can see is that there is not much room, especially in those early years, between that line, the revenue, and the debt service. So we don't have much flexibility, much room there. We're not able to meet our toll covenant, our debt service covenant without using escrow defeasance funds. And there will be added pressure on the toll rate setting process as we move forward. There also is very little room for any economic downturns such as we've had. And also there is no cash flow or debt capacity for projects. We've been working on this project for quite some time now. We started back in June of 2012, brought it to the board in December where we had an approval for the parameters of the financing. Worked with the rating agencies in January and February. February through May, we negotiated with Caltrans on the cooperative agreement. And in May, we brought the cooperative agreement to this board, and in June, we brought the refinancing with an extension of the debt to 2053. Both of those items were approved by this board. We also received investment grade ratings on the refinancing transaction. And then at that point in time, the cooperative agreement was not signed, so we continued negotiations with Caltrans from June through August. And during that time, interest rates increased to levels that prohibited us from continuing with this refinancing transaction. However, we've been very fortunate. We have had some positive movement in the market with rates coming down, and now we are in a position where we are ready to present something to you today. And we've also been able to work out an agreement with Caltrans. There are also some other outside factors that I think are important and who have commented on the refinancing transaction. In addition to our credit rating agencies, We also had a review by the California Debt and Investment Advisory Commission, which is a division of the State Treasurer's Office. They reviewed the refinancing transaction, and one of their comments was that the agency's restructuring is in the best interest of the agency, as well as in the best interest of its bondholders, other stakeholders, toll road users, and the public in general. Also, Fitch has just recently made a comment that the proposed 13-year extension of the cooperative agreement is critical to the successful execution of the transaction. And in the absence of a meaningful restructuring, it is Fitch's view that the financial profile of the existing debt is not consistent with investment grade. As you're aware, we were put on a credit watch by Fitch, and we have 3 to 6 months for them to review and make a decision as to whether to downgrade us to non-investment grade. And the consequences of that happening is that there is market, public, and reputational stigma, greatly limited financial options, much higher borrowing costs, if any at all, and a long recovery to return to investment grade. Once you get down that road, it's very hard to come back. The provisions of the cooperative agreement that we were able to negotiate with Caltrans, there were some additions that were made after you approved in May, and the substantive changes in that area would be paragraph 11, there is a tolling limitation that was included for south of Oso. Tolls would not be collected past 2040. North of Oso, beyond January 15, 2053, unless extended by mutual agreement. Paragraph 12 includes the same annual payments that you approved before for the years 2041 through 2053. However, rather than making one lump sum payment at the end of each year, those payments would be made throughout the year. The $2.4 million in paragraph 13 is the same as you approved in May. However, we have agreed to set aside those funds in a separate account. Paragraph 16 indicates that the payments that are scheduled to be made in 2041 through 2053 will now be treated as current expenses, which is first payment out of toll revenues rather than from surplus revenue. And we added paragraph 22 as well, which allows for a termination clause. And I just wanted to note here that the payments have remained the same. $215 million in future dollars, which equates to $32 million in today's dollars. As I mentioned, the Caltrans cooperative agreement approval is necessary in order for us to restructure the debt to 2053. And so I'd like to remind you what we discussed in June and those reasons for the decision of extending out to 2053. This will help us to maintain our investment grade rating, improves our near-term excess cash flow, creates a margin to withstand economic downturns, and also gives us flexibility in setting our toll rates. There's not as much pressure on increasing those rates. It eliminates the need to use escrow defeasance funds to meet our coverage requirements. It establishes a manageable growth rate in the debt payments and lowers the peak debt payment, and establishes the ability to either pay down debt early or to fund major projects. And this also guarantees local control over toll revenues and rates on the existing system until 2053. Here's another chart that I know looks like it has a lot on it, but I'd like to point out some very important points here and the logic behind extending out to 2053. The bars, the colored bars, once again represent the proposed debt structure of moving out to 2053. And above that, 2 lines up, you see the red line, and that is the same traffic and revenue numbers that I showed you as a black line on the last slide. And right below that, the squiggly green line represents your current debt service. And as I showed you on that other slide, the space between the red and the green is not very big. We are adding additional capacity by decreasing this debt service, the growth rate becomes manageable to 3.6% as opposed to our 4.4% that we currently have, which is very high. The peak debt payment is much lower at $263 million. And this gives us the margins that we need, the room for error, also the flexibility in the toll rate setting process. Does not require the use of the escrow defeasance fund, so we can make our toll covenant without utilizing that fund. And it helps, adds additional debt capacity in order to fund projects, or if you so choose, you could pay that debt back early. And we also had looked at this in June, but I'd like to remind you again as to the reason that it doesn't make sense, or why we can't restructure to something less than 2053. It really does not allow us to meet any of our goals. The first chart on the left shows you a refinance with no extension, which is very similar to also a do-nothing situation. And what you see there is you really are not in a very good situation, and you will be downgraded. On the 5-year extension, which is just another look at it, you really don't gain anything. You get a little bit of room, little bit of extra cash, but you still have to utilize the escrow defeasance all the way through, and you will also be downgraded in a situation like that. So here's a look at the interest rates and what has happened since you approved in June. So we start over with May and June, where interest rates were very low, and then they really creeped up too high for us to execute the transaction. And we were very fortunate that we did have a decrease over the past month, and that is why now we are here before you today, because we feel this is our window of opportunity to take this transaction to the market. And right now we have, where we are today, we do have an opportunity to present something to you that would allow us to enter now, and those are rate reset bonds. And I will be discussing those in detail on the next slide, but this also shows here that as we're working through the process, if we receive approval today to move forward, if rates continue to decline, we would still be able to do an all-fixed deal as well if we have another decline in rates of about 30 or so basis points. So here is a look at the rate reset bonds. And so this transaction assumes that we could enter the market today, or at least attempt with the interest rates that we have today. And this includes $375 million of rate reset bonds, which are short-term fixed-rate bonds that what we're assuming here would be in 3 $125 million series with rate reset dates of 5, 7, and 10 years from the date of the refi. These are long-term bonds that pay a fixed interest rate during that short-term period, and then at that point you do have several options that I'll go through. But they do have a final maturity in 2051 through 2053, so it's not that your principal becomes due in those short-term periods. Just comparing the all-fixed rate deal to the deal that would include a small amount of rate reset bonds, the advantage is that the interest rate is much lower on these bonds, so it brings the total cost of the transaction down to a level that we could execute a transaction now. These, what happens with these, there is some risk, because after these 5, 7, and 10 year periods, you need to remarket those bonds or do something with them that based on those market conditions at that time, and also on the credit rating of this agency at that time. What happens is you have 3 options basically at that time. You can reset the rate to the current or the then current market rates for another short-term period, or you can set the rate to the current market rates for a fixed amount throughout the entire maturity, or you can take cash and you can call those bonds, pay them off, or refi and get rid of them. So here is the key details of this refinancing transaction that includes some rate reset bonds that would allow us to execute a transaction without any further decline in interest rates. It's mostly, let me step back, same as presented to you in June. It assumes that the 1995 bonds would remain outstanding. However, they would be re-amortized, and what that means is currently the principal amount is all due in 2035, and what we would do instead is have that principal amount due in 2033 through 2035, bringing down those amounts. The 1999 bonds would all be refunded, and what we show you here is current interest bonds of about 1.4 billion, capital appreciation bonds of around 300 million, which is the same as what you had approved in June, roughly. This includes the rate reset bonds that we were just talking about of 375 million, and the subordinate or junior lien bonds that we had also had in the transaction in June that you'd approved of about 200 million. Those are the ones that are rated a little differently. However, there is certainly an advantage for issuing those bonds. It's much cheaper, allows us to issue less cabs. What this transaction does is that it would create a cash flow savings or gross savings in the very near term of about 400 million, and in the term from 2014 through 2040, you would save $1 billion. On that, if you take the cost though, because of course you're adding debt out on the back end then from 2041 through 2053, but if you take the what we call the present value or the time value of money and you convert that into today's dollars, including all of the costs related to executing this transaction, it only costs you about $160 million, assuming that the rates don't continue to drop. So that's what you could do today, and you could achieve all of the benefits that we've been talking about, giving you more flexibility, giving less pressure on your toll rate, increasing, preventing a downgrade, doing all the things that we talked about. The schedule, assuming that we would receive approval today, we plan to meet with the rating agencies next week. We would then expect to receive ratings by the end of October. We would also be working on all of the documents, finalizing the bond indentures and making changes to the preliminary official statement, updating with all the current information. We would launch the investor marketing program in the weeks of November 4th and 11th. We would expect to price the bonds the week of November 18th and then close the transaction the first week of December. Here's some good news as part of this. The transaction fees have decreased since June, getting rid of, or having all of the bonds callable today and being able to eliminate some of what was necessary there to take out those bonds that were not callable really decreased the cost. We were estimating underwriting fees in June of 22.9 million. Now those underwriting fees have decreased by 4.5 million to 18.4 million. Total transaction that we had presented to you, total cost all in was approximately 26 million in June, and now we're looking at about 22 million, which is about 1% of the transaction. And when comparing that to other transactions that this agency has executed, the 1999 refinancing 1.4% and the 1997 San Joaquin financing 1.5%, this is substantially less. So in conclusion, this bond refinancing plan achieves the agency's goals, lowering debt service near term to improve financial and toll flexibility, capacity to fund new projects, near-term cash flow, and long-term debt capacity retaining local control over tolls and revenues, and avoiding a downgrade and preserving investment grade ratings. The amendments to the resolution that is before you would include parameters that we would be authorized to go out and execute a transaction within. And that indicates that the true interest cost has to be less than 6.5%, the underwriter's discount less than 0.95%, the final maturity would be 2053 or earlier, and the maximum amount of rate reset bonds would be 500 million, and also would allow us to explore rate lock options. So the recommendation before you today is to authorize the Chief Executive Officer to execute Amendment number 5 to the Cooperative Agreement for Foothill Transportation Corridor, and Amendment number 6 to the Cooperative Agreement for Eastern Transportation Corridor. And the second item is to approve Resolution number F 2013-09, amending and supplementing Resolution F 2013-07 that was approved in June 2013, authorizing issuance of toll road refunding revenue bonds in order to refinance toll road revenue refunding bonds series 1999, and approving certain documents and authorizing certain actions in connection therewith. And that concludes my report, and I'd be happy to answer questions.
Directors, questions? Director Shea.
Yes, thank you very much. I appreciate your tenacity trying to work through this for the last many, many months. A couple points I want to ask about. This $163 million it costs to do this refinance. You're indicating that the underwriting fees are about 19 million. What's the other 145 million costs? I mean, can you break that down more specifically of what we're talking about?
Right, so what that does is that actually takes into consideration all of your debt costs. So obviously, we're decreasing your debt payments from now until 2040 by about $1 billion. But of course, you're adding on the 13 years, so you have payments out in the future. But when taking into consideration the time value of money and the value of what you're getting now in these early years versus what you'll be paying out in the future, that's how we calculate that number that comes up to what does that equal today, and that's what's in that number, including the cost of the transaction itself. So it's really all of your debt. It's looking at the transaction, the complete transaction, and what does it cost you in total.
So, but the underwriting cost of being 19 million, I mean, what is I understand that part about the debt, but what specifically are our upfront costs, do you feel? Is it just the 19 million?
It comes out to about 22 million, and that does include the other costs that I had presented in June. Those are pretty much the same. I have a summary here. I can kind of just give you an idea of what those are. For instance, there was the traffic and revenue study, rating agency fees, agency counsel, bond counsel. There's a number of fees, and so those are the difference between the underwriting fees and the total fees of what I'm
So it's like
estimating.
4 million. Are we really good at negotiating with our legal team and others to keep these costs down when we're doing this?
Those all came before the board. The other costs have all come before the board, and well, actually, all of these costs have. You approved them in June, and it is my job and our CEO's job along with our financial advisor also to continue with the on the underwriting fees as well. And also, when we price the bonds, that's where I think we can really add value as far as ensuring that to trade off sometimes on the fee versus what you can get and what you're paying in bigger dollars for the actual debt payments. There is some trade-off, and sometimes it makes more sense to pay a little more in the fee to get a better deal.
Right. Just another question. It says November 18th around the rates. I want to know if it doesn't drop those 30 basis points, then we're looking at going with this structure of all these 5, 7, and 10 years. If it does drop by then, I would assume that the fixed rate of 85% we're looking at and these other bonds will all be fixed rate at a lower level. Is that correct?
Yes, what we're asking for today is the authorization for the chair, the CEO, and the CFO to work through the market and the interest rates and what is best in the end for the cheapest and most efficient deal that we can come up with. So, yes, I would say most likely if interest rates dropped to the 30 basis points that we're looking for, it would most likely be an all fixed deal. But there might be something to our advantage to include a small amount of rate reset bonds as well, that made the overall deal cheaper and just more efficient.
Okay, because I'm not real supportive of that, but if we can really diminish that and have as many fixed rate bonds as possible, that's what I would prefer looking at. If at this point we go to secure, or we're at that point that we're ready to do a deal and the interest rates go up, we're not doing the deal, is that correct? Well, is it come back to us? What would we do?
Well, we're asking for authorization to issue a maximum amount of $500 million in rate reset bonds. So we do have a little room there. Plus, there are some other things too that we're looking at to hedge a little on reducing that risk of the market rates rising. So we're also asking for authorization to just look into some of those options out there. And if there is more that you need to hear about that, I'd actually ask my financial advisor to come up and speak about that.
Yeah, so to clarify, Christina, the authorization we're giving the finance team today, if we move forward on this, is to take a look at the market over the next X number of days,
Right.
because the rates could continue to drop, and leave it to their discretion of what is the best deal for the agency, whether it be all fixed if we get a 30 basis point drop, or to go with a kind of a hybrid of that with some of the rate reset
And I
bonds.
understand, I'm just saying, what if, as we're looking at this, we're starting to see rates go up again? Do we pull the plug? Do we come back to the board? I just want to understand that.
If it's within the parameters that you approve,
Right, well then.
then
yeah,
I think we would just make the best decision. We would look at it and determine whether it was still something that made sense for us. And if it's not within those, obviously, we would have to come back.
Okay, thank you very much.
Madam Chair? Madam Chair?
Director Spitzer?
Yeah, I wasn't gonna start there, but let me dovetail there. I want you to look at the resolution that we're being asked to approve on, it's paragraph 5 of before it's the first section thing. You look. Just for the record, we got a lot of these documents about 5:30 last night. And I think all of us are trying to do our due diligence and digest all of these documents as quickly as possible. I do want to commend. What's that? Whoa, that was a little crazy. Commend, I'll use a different person now in that context of the sentence. I want to commend our CFO, because I met with her last night and she was very helpful in providing documents, which I'll get to in a minute, as well as our finance team. But if you look at paragraph 5, we are authorizing them to act alone, not in conjunction. If you look at the PowerPoint, it leads one to believe that it requires all three to assent to the deal. It says the chair, the CEO, and the CFO. That's not what the resolution says. The resolution says Lisa can do it by herself without any other authorization, Amy can do it by herself without any authorization, and Neil can do that. I have to tell you, on a $2.5 billion deal where it's Carroll, Merrill, Door A, Door B, if interest rates do not go down, they're going to have to blend this with these redeemable variable rate loans, mortgage bonds, which could go up to 12%, depending on what happens when those get called. So I don't recommend on something this complex and this important, dealing with the entire refinancing, that it doesn't require the approval of all three.
I agree.
The word, and if you look at the resolution, that phrase, each acting alone, should be stricken, because it's being represented to us, it requires all three. If we are gonna delegate, and I wanna get to that in a minute, then it should be all three minds have to come to an agreement on a deal, not just one. And the way it is now, like I said, any one of them could make a decision. So my recommendation is you strike each acting alone from the recommended action, and then I read through all the indentures last night, and it's repeated throughout the document. So anywhere it appears in the document as acting alone, I recommend taking that out. The other thing is, let's talk about this deal for a second. So I as an elected official, to the best of my recollection, have never approved variable rate debt. It's really not an instrument that's normal that we see. You know, OCTA is always fixed debt. City council is generally parking structures, it's fixed. It's in other words, you sleep better at night, you know what you got. I never wanted to do a home loan with variable debt because I didn't want to wake up one day and find out I was paying 12% interest. So the thing is what our CFO has indicated is that depending on the deal, the interest rates, they will blend that up to $500 million. That's a big window. What I'm concerned about is they still have to go to the rating agencies, and that's supposed to happen next week if I understand it. So I asked for other deals in the nation where this concept of rate reset bonds is used, which is delineated in the staff report. It's called something else in other contexts. In fact, we don't even call it rate reset bonds in our own indenture definition, but I guess for purposes of ease, it was called rate reset bonds. So they gave, you look at the bottom of our staff report on page 5, there's two models that they are citing that were used for these rate reset. University of California and the Grand Parkway Toll Road. So I read those indentures last night, and I read the rating agencies' reports on each one of those deals. And the Grand Parkway Tollway is very different than our tollway. Those bonds are backed by TIFIA loans, and they're guaranteed by the state of Texas. So the government is a big player in backing up their bonds. We don't have anybody as a backstop like Texas does. Texas is saying, hey, listen, we're gonna build private roads, but we're gonna utilize the government to securitize those loans. So that's a big difference here. We don't have a backstop or a safety net. And with respect to the University of California, they rated those favorably too because they cited the region's ability to raise student fees. They have a lot more discretion on raising revenue than we do. Our only source is toll revenue or developer impact fees, and those are limited. So we really have to look at toll. So one of the things I was going to suggest today is that I understand the need to be nimble and flexible, but I really think this board deserves another look-see after they meet with the rating agencies. I think the rating agencies need to opine on how they look at this structured deal, especially with the use of RRBs. And I think we should have the ability, even if it's a telephonic call into the Brown Act, to at least be briefed about what the blend is as near in time as possible to a deal, so we can decide if we have a comfort level. Because today we're authorizing, right now we're authorizing one member, our chair, the CFO, the CEO, to do a $2.5 billion deal and to blend it however they want. That's a lot of discretion, colleagues. That's a lot of discretion. So I would ask somebody to think about how we can not muck up the works, but have the ability to weigh in before we actually would say that's the deal that we're comfortable with. So that's point number one. I want to look at, financial ad hoc. It doesn't matter to me. I talked to the chair briefly. I mean, I think a member of this board, the chair primarily, if not somebody else, maybe two directors, should go to the rating agencies, okay? I sat with the rating agencies when the San Joaquin was exactly in this situation when I was chairman. And I didn't know all this. I mean, I have to commend the staff too. This agency is much more transparent than it was back in the days when I chaired the San Joaquin. This was going on at the San Joaquin back in the late 1990s, but we, the directors, did not understand it or know it. So that's a huge improvement, but there's nothing like sitting across the table from the rating agencies. And I will tell you what the rating agencies care first and foremost about. They care that the board has the intestinal fortitude to make difficult decisions about protecting the bondholders. That's what they care about. If they don't think that this board will engage in gut check time to make sure that this road is financially solvent, they will not rate this offering favorably. They really, really weigh heavily the political will that we as electeds hold on this board. Now that being said, I want to look at the cooperative agreement. I actually have the draft of the cooperative agreement that was submitted to Caltrans. And I have a copy, which is in front of us today, of the final version, which was signed by Director Chamberlain. And I want to talk about paragraph, it's kind of morphed because the numbering changed a little bit, but it has to do with the first point. Is it possible to put up the slide on the cooperative agreement? It's, what, 4? So my question is our initial offering to Caltrans, the language said, the quote, "The extension of toll operations provided to agency," which is us, in this amendment number 6, does not apply to the extension of SR 241 south of Cowtown. In other words, we wanted to ensure we had the ability to toll south of Cowtown, and Caltrans came back and said we cannot continue to toll south of Oso, so they ratcheted it back a stop beyond 240, and we cannot toll anywhere in the system beyond 253. So my question is Foothill South essentially dead with this cooperative agreement? Because if you cannot toll south of Oso, that means that Caltrans is tying our hands on our ability to build out the network, the way I read this, because if we start building Foothill South today, you can't finance it and be done with your financing by 2040. So I want to know if this ties our hands, this cooperative agreement ties our hands in our ability to build out the system.
Well, it does say in the agreement, unless extended by mutual agreement, so there is that provision in there where both parties can agree.
Okay, then I just want to make sure it's very, very clear that that's not what we asked for, but that's what we got. And Mr. Chamberlain, I hate, you know, I have amazing respect for you, and you and I lately have been sparring a little bit only because we have very different roles, but I still, you know, I hope you know this is all professional. I just want to understand why your signature is on this cooperative agreement. You were delegated the legal authority on behalf of the secretary to sign this cooperative agreement legally on behalf of the state of California and by the state of California. What is the logical rationale for tying the TCA's hands to not be able to toll south of Oso beyond 2040? What's the logic of that?
Yeah, I think the answer to that is that we've stressed from the beginning with Caltrans that the purpose of this refinancing was to refinance the existing road and the existing debt. And in no way were we trying to use this in any way to finance the 241 South extension. And that language was put in there by us actually initially to clarify that point so that it was clear that this was strictly a refinancing of an existing debt situation. The second point I would make is that to go south on 241 down to I-5 and what have you, the costs associated with that are significant enough so that when and if that occurs, it will require a totally new financing situation that will have to come back to this board and have to come back to Caltrans for discussion at that point in time.
Well, I appreciate you answering the question, and if that makes things easier, I'm willing to live with it. But my question is are you saying the TCA went on the record in negotiations on the cooperative agreement to prohibit tolling south of Oso past up until 2040? Is that the position of TCA, that we cannot collect tolls south of Oso past 2040?
No. What I was just referring to was south of Cowcamp on the 241 South. What you're referring to is that language was changed to south of Oso in the subsequent negotiations. And our desire would be that the language was south of Cowcamp. In the end, on the negotiations, south of Oso was what ended. That's not ideal from our standpoint, but we can live with that. Does that answer your question?
Well, so then you don't see this cooperative agreement in any way whatsoever tying the hands of this agency to build out the network? Does it have the potential to do that?
I think the answer to that is that in order to go south, on 241 South, the way it's normally thought of, the size and the magnitude of that is such that we would have to come back not only to this board, but also to Caltrans in any case. So the purpose of this agreement is not that. The purpose of this agreement is to refinance the existing debt on the existing road.
What about limiting us to 2053 to collect tolls system-wide?
Our read on that is that language is specifically geared to the existing roadway that this particular cooperative agreement is focused on. And what that language is saying is that at the end of 2053, we will have paid off all of our debt, and therefore it does go to, we are not putting more tolls on that road. Now, there's also, as the chairman indicated, language that was added, that if for some reason something happens in the meantime, the two agencies will sit down and, as we have in the past several times, cooperatively extended the agreement as necessary to meet the situation.
Okay, and then lastly, on paragraph 15, again, I may have my numbers wrong because it got renumbered. Look, I've stated this publicly. If we're going to extend the debt on this road, and Caltrans is maintaining this road, they made an agreement with us to do the maintenance on this road through the original debt period. If we're going to extend the debt, Caltrans has every right to be paid to continue to maintain this road, even though we give them this infrastructure for nothing. But that was the original deal. So when you look at paragraph 15, we originally had proposed that we tacked on that on the end of a refinancing. They're asking for it on the front of the refinancing as a current expense, right? So it comes off the top as opposed to on the back end. I don't have any problem with that whatsoever, and I figured that wouldn't survive the negotiations anyway. But the point is that, you know, if we're in this together, like I use the Texas situation with the Grand Parkway that being cited on staff report, that is a partnership with the state of California and the TCA. And obviously we have a partnership with Caltrans and the TCA, and that's why we have this cooperative agreement, and it is a precursor to our ability to fund these roads. But I understand that we wanted to look within the four corners of the financing and not indicate in any way whatsoever it had anything to do with anything else vis-a-vis the building out of the network. But it appears to me that, and I'm not saying Mr. Chamberlain or at his level, but at the highest levels in the state of California, it seems to me that that paragraph was negotiated to make it very, very difficult for this agency in the future to build out the toll road network. And I interpret it that way, and I think it's important for people to understand that it will be a negotiation for another day, but it could very well tie this agency's hands as part of the cooperative agreement. And then I don't know what the comments are on my first, I'm sure I don't know what the reaction is to my suggestion about a stutter step. One, eliminating, and it's not a disrespect to any one individual. I just don't think one individual should have that much authority to ink a deal.
Why don't you make a motion to that? And
Well, because I'm not ready to make a motion to support the whole thing, so.
well, I mean, even just that component of it, because I agree with you.
Well, I guess it would be a preliminary then. I'd make a motion that on the resolution, that we strike the word, I lost my place. On paragraph 5, I would just strike the word each acting alone, and that way they all have to act together. And then I'd ask that there be something, and I heard some comment about the ad hoc. I would feel comfortable if it was properly noticed, and that wherever we are at any period of time, if you call in, you call in. If you don't call in, you don't call in. I mean, the Brown Act was amended to allow for telephonic calls. You just have to post it, and you have to post where you think you're going to be at the time you're going to participate. So I highly recommend that you all have an opportunity, and I would like that opportunity, to be able to weigh in after Wall Street weighs in with the rating agencies. I'd like to understand what their thought process is, what their reaction was, whether they had any feedback on this particular proposal, whether they had heartburn about the RRBs in light of the fact that it's different than the models as outlined in the Grand Parkway at the University of California. And then, so I would say, hey, you can give a tentative indication today on this deal. You go forward, start to work out the deal, be ready to execute. But this board gets one more bite of the apple.
Madam Chair, may I make a comment?
Yes.
As far as the rating agencies go, if we were not to be rated investment grade, we would not have a deal. So you would have some assurance there that if we don't have a favorable outcome, we don't move forward. And as far as the other item, I think the intent as far as the authorization is to allow one of those three to actually execute and deliver the documents. However, I talked to my bond counsel, and we had some language that we could insert that discussed an ad hoc committee of the three, the chair, the CEO, and CFO, to determine what that course is, but then still leaving the actual execution or signing of those documents to one, because what happens is when you're in this transaction and you're trying to execute the deal, sometimes it is difficult to get all three, and that's the reasoning and logic behind it.
Well, I would just say on the $2.5 billion refi, where the future of the agency is at stake, if it's hard to get those three together to ink this deal, I got a problem with that. I mean, now the chair maybe because she's, but we have fiduciaries in you and the CEO. I mean, if you all three can't get together to sign it at the same time, I got issues. I mean, so I'm not comfortable with delegating that document, given what's at stake here. But if the others are, then I'm open to recommendations. What was you had some, Madam CFO, you had some language that bond counsel suggested?
Yes, I'm having a tough time reading it.
I mean, maybe you only need one signature, but there has to be something leading up to that.
I'm asking my counsel to come on.
Brian Ford, I'm driving Yaka. Sorry, they didn't teach me handwriting in law school, so I apologize.
You're speaking way too fast.
Sorry.
Pretend we're all court reporters.
Yeah. So the language that I had proposed was in the section 5, that just to address your concerns, Supervisor Spitzer, was that so in the third line where we say the issuance of the bonds, to insert after the comma there, an ad hoc committee consisting of the chair, the CEO, and the CFO is hereby authorized and directed, is hereby authorized to direct any and each of the chair, the CEO, and the CFO to execute and deliver those documents. So in other words, an ad hoc committee of the three would meet, they would decide on it, and then they would then direct.
As long as the ad hoc committee is all present and they vote. In other words, you can't appoint an ad hoc. They all have to be present and vote to authorize it.
Correct.
Which
We could clarify that in the language here.
I'm comfortable with that.
Okay.
Great, thank you.
Thank you.
Are you finished with your comments?
Yes, thank you.
All right,
Madam
thank
Chair?
you. Yes.
Madam Chair, over here.
Director Hoyts, go ahead.
I'm concerned, with the latitude we have the cost of $163 million, but we have a savings of potentially $400 million to $1 billion. Is that correct?
In the first 40 years, we would save $1 billion.
Okay, okay, that's clear. Now, with the reset bonds being at 4.0 to 5.5, and our fixed rate bonds 6 to 6.5, I actually agree with Director Spitzer. I feel a little uncomfortable with having a blended thing here to where we're trying to get the best out of it. I know trends are going down, but do we have any sense on where we're at right now?
Well,
On that 32 point?
unfortunately, we had a little bit of a move in the opposite direction yesterday.
The markets are the markets are a little unsteady. As you can imagine, there's an impending default on U.S. debt next week. We've had the Treasury market and our market sell off the past couple of days. I hope we keep our fingers crossed they remedy the situation in Washington. Maybe we get a slingshot effect. Treasury starts to rally, rates starts to come down. Of course, the other factor is if there is an economic effect, which Christine Lagarde was chastising the United States today. If there's a global economic effect, that could also result in lower rates. So we're watching the markets like everybody else, but it's a unique situation.
So as we're looking to this, we get the green light if we get a 32-point drop, or within this blended market, are you trying to blend something together that would be a 32-point drop?
Well, the entire transaction has market risk in it, because we're going to have a period where we're not going to be we're not selling the bonds for some period of time. And even at that time, we'll we'll see if we can get the entire deal done within the constraints you provided, given the markets that we have. And I think what we're trying to do with the rate reset bonds is add something that allows us to get the majority of the deal done in a market that is a good, a favorable market, with a small portion, 17%, at market, having market rates.
But in your report, it's not greater than such and such. We have
Yeah,
stipulations.
it's 500 million, it's about 20%. The rating agencies have certain parameters they don't like you to go beyond with respect to market risk and interest rate risk. You know, what we'll see at the time with the restructuring is a stabilized credit, greater margins. We run numbers where we've run numbers looking at what happens if we went to 12% at those times for the entire deal, and we still make coverage without toll increases. So the margins that we create in doing the transaction give us a pretty substantial cushion to absorb interest rate risk on that small portion. Unfortunately, they don't give us a cushion to absorb interest rate risk on the entire transaction.
Okay, but on that, so basically, if we vote today, we give you rate lock options, correct?
Yeah, rate lock is a different animal than the rate reset bonds. The rate reset bonds, just because of the nature, they're shorter in duration, they bring down the overall cost and make the deal more economic, so we can get at least, 85% of it or 83% of it done at a favorable interest rate, and then take some risk on the 17% balance. And like I said, we'll be in more stable financial position at that time. And the markets, there are situations where there are aberrations in the market. Usually they're driven by credit risk. We're going to stabilize that with the restructuring. And then, there's always prospects for a global financial meltdown, which we saw a few years ago. But we're pretty confident that with a stable credit and with the measurement, the sensitivities that we run, that those bonds, we can remarket those bonds in a way that fits within the parameters without toll increases.
Thank you.
Because of the margin.
Directors, additional questions? Yes, Director Nelson?
Does somebody, I apologize because I don't have the PowerPoint, I don't know that any of us do, but can you go back to the slide that sort of captured why the rates of when we did not refinance?
So the rate slide at number 8,
Yeah.
is this the one you're having?
Yeah, so we were gonna try to lock in and we didn't. And we didn't because the rates had increased above, what, like 6.3%?
We didn't have a cooperative agreement, and that's why we were sitting there while rates rose to a level then that didn't make the transaction work. So it was because we could not enter the market.
I mean, is it our sense that at 6.5%, because that's what the authorization, we've got some rosy forecasts, but the authorization is asking for a blended rate of 6.5%, is that what I understand? That was slide, I think, 13 that we're just looking at.
That was the.
So we could actually have fixed rate debt, I can't do the math in my head, but closer to 7%, but variable rate debt down at 4%, and as long as our blended rate is, for the total transaction, is 6.5%, we're green lighting this today, right?
As long as it doesn't let 500.
Yeah, I mean, it's.
But you're right, otherwise.
Right, I mean, I just think that's important everybody understands. We're talking about all these different rates and 6%, we're hoping the rate goes down. And slide 13 says that as long as by issuing $500 million of variable rate debt, you can issue long-term debt well above 6.5% to get to your weighted average. Just please know that that's what we're agreeing to. It's not made very clear in the slide, but it is in the slide. You just gotta dig it out. You're agreeing to some long-term debt at those high prices that cause us to not be interested in doing the refinance in the first place, other than the cooperative agreement.
Yeah, that it is right. The true interest cost is at 6.5%. We're actually pretty close to an all fixed rate deal at that high rate now. I don't know, we haven't run the blending, whether it's exactly that you could go to 7% and then blend down only 7%.
Nor have I,
But,
I mean, I gotta guess a little bit.
Yeah, but I mean, I think when we came up with the 6% blender or not, it's the transaction that gets you the savings parameters or the dis savings within the range of dis savings parameters, for an extension of 13 years. So I think we're pretty comfortable at that rate, and then we'll see how the blend looks overall. But you're right, and at any rate that you have, the fact that you have market exposure on 17%, depending on how that resets at those times, that's going to affect the overall rate. So the overall rate's going to be affected until those bonds are fixed, but we're pretty comfortable with the 5-year intervals. We ought to have competitive financing, and one that in the long run puts you in a better financial position.
Bob, through the chair, look, I've known you forever, and the fact is that, and you've done an amazing job for both agencies, and I want to thank you publicly for that. I've spent a lot of time with you at Wall Street too.
Yeah.
And the thing is that you're asking us to get out of hot water right now by structuring a deal that has fixed rate and variable. The fixed rate, we don't even know what that number is going to come in because you're going to blend it with variable to make a favorable interest rate to get a deal. When those bonds, the variables, get called, we don't know so we're going to end up with a rate we don't know yet today on fixed. We're using the blended to drive it down. The day that comes, and that's the stomaching of, as an elected official, you have the stomach to understand what a variable rate might be when the firsts are called. And now at least it's capped at 12%, but 12% is a huge number, and I know there's options at that time, but to be really fair, which is the reason I asked for another full board meeting before you pull the trigger as close to the ability to do that with some flexibility, is because I asked last night to the CFO, what other deals in the state of California use variable rate notes? Because I really want to understand what examples in California, and I was cited state of California and University of California, and have already distinguished what happened at the University of California. They had the ability to raise revenue through the regions. We don't have the ability to raise revenue. So the deals I've looked at always had a different scenario than we have, Bob.
Yeah.
They had University of California behind them, regions, state of Texas behind them.
Yeah.
We don't have anybody guaranteeing our debt to pay off these variable rates. Texas is using TIFIA and the state of Texas. So I know I have discovered, I've heard some other board members talk about variable rate. You don't sleep well at night when you don't know what the interest rate's gonna come in on the day of reckoning. So my question to you is, what other entities have used it in the state of California? And under what scenarios? Has anybody where their revenue stream is limited to a specific revenue, like we are? We can only use tolls. We don't have a sugar daddy. Is there any other model that you can point to in California that says, yeah, we have a like scenario?
Yeah, my client in the north, the Bay Area Toll Authority, has used a lot of, and these aren't, I wouldn't characterize these as variable rate because the reset, the remarketing, the refinancing is a longer period. You get a long period of fixed rates. But, for example, we've used floating rate notes and other variable rate products in the Bay Area Toll Authority in order to reduce costs and take advantage of the shorter end of the yield curve, which is very, very competitive.
Has any agency in Orange County?
I don't know of any.
IRWD is.
You better come to the mic.
I don't cover it. I don't comment about any of
Tony Hughes at Barclays, at one account. Yeah, IRWD is
You
what
gotta
I was
state your name
mentioning.
for the record.
Tony Hughes at Barclays Capital. Yeah, IRWD, I've not been the banker there, but my understanding they've financed their entire debt portfolio with variable rate bonds. OCTA has been an issuer of variable rate bonds. I hear somebody mentioning the Orange County Sanitation District, Orange County Water District. I would hasten to guess that maybe 20% of the entire California municipal market over the last couple of decades has been variable rate debt. So yes, everybody has a different reason, a different revenue profile to support it. But over the years, those people who have financed in the variable rate market have enjoyed a lower cost of financing, and that's why they continue to do it. There are different risks associated with it, and you need to be able to understand them. You need to be able to be in a position to manage them should they result. But it's not an unusual technique, and that's why it's being acknowledged and recommended here. The RRBs are a special class of variable rate debt that bring significant advantages in this situation as well, which is why they're being included in the recommendation.
Madam Chair, can you just ask a quick question? Okay, Director Murphy was next. And then Director Shea.
Well, thank you, and actually Directors Nelson and Spitzer hit on the crux of the question, and that is, in reality, from a conceptual standpoint, we're being asked to vote on what I'll call a worst-case scenario, but there's unknowns with it based on the variable rate of some of the bonding. So they both touched on the issue, just calling it a different thing, but folks were asking what the authorization is, and I think Director Boyd's hit on it a little bit too, but in reality, the way I sum it up, and I'm just a simple guy, I'm a salesman, so I'm not involved in all these highfalutin financial things every day, but I can tell you what's being asked of me, the way I read it, is an absolute worst case scenario that if all those conditions are met, the thing is done, assuming acceptance of the agencies and the rest, and if you're comfortable with that, that's kind of the decision, and if you're not comfortable for any reason, you should question that, and I think that's what we've been hearing the discussion about. So I'll leave my comments at that.
Okay, Director Shea.
Yes, I just want to follow up in regard to, number one, this discussion is very important about this variable rates. The issue is at the 5-year point when these come due, the first 125 million, I understand that there is the fear that these can't be met. Do we not have, by refinancing, enough cash on hand to just pay this off so we're not living in this anxiety and this fear? As long as we're not spending it on whatever, and maybe we need to have some kind of policy that suggests that for the 5-year, 7-year, we have to have backup cash on hand to pay these off if we come to a point that the rates are so high. So give me some, security that by doing this, that we would have something in the bank to cover it if in fact the rates are so high, we'd be in a bad position.
Yeah, that would certainly be one of the considerations. I mean, obviously one of my concerns too is ensuring that we are handling the risk properly. So those are the things that we would be looking for is looking at what we could do to mitigate any risk.
Yeah, as I said, the restructuring in and of itself creates additional margins. And so it's going to, and that's one of the factors that Supervisor Spitzer mentioned. We have to talk to the rating agencies about. The rating agencies are going to look at your liquidity and your ability to handle those bonds. So there is additional cash flow that's created by the restructuring that's going to give you the ability, if there is some market dislocation, to use your cash and either to take those bonds out or buy them down or some other liquidity move other than refinancing them. So you do have those kinds of options, and if the market is strong, you've got them maturing way long anyway. We can take them out with fixed rate bonds at that time, those chunks, and we carved them into the 125 million for exactly that reason, because they're more manageable pieces for the agency to deal with the options that are available.
So just clearly, at the end of the 5 years, when these come due and the rates are too high, we have the liquidity to pay these off. Is that
We
what
should
you?
have 125 million. We don't.
By the refinancing, I thought we talked, I just want some clarity on that.
Well, right, we run the numbers at 12%, and it fits within the revenue envelope at the worst case. But yes, we would have the money that the restructure is going to create during those first few years.
I don't see the slide up here, but it seemed substantial, so I just
Should be
need to hear
120.
that.
It's more than 120.
Mhm.
Right, if we couldn't remarket them, the worst case is it goes to 12% interest, and then you have to figure out what you're going to do. But we ran numbers, a scenario, what if it did do that, and we would still be able to meet our debt service coverage ratio without using escrow and fees. And so that's just to give you an idea of, not that we would leave it at 12%, we would obviously make the right decision to do something.
Or could
but
we put half the cash in a refinance, half that part of that debt? There's gotta be, I'm just not hearing specific ideas of how we would do that, but you're saying we're able to do that.
Yeah. still have cash.
Well, Madam Chair, I mean, look, I have your PowerPoint presentation from the June 30th when we did the finance
Okay.
original, and I know it's changed. But one of the things that you presented was the refi would eliminate the escrow defeasance fund, which helps us,
The use of it.
Right.
eliminates the need to use it to meet the bond covenants. Okay, that's exactly what you said. However, what I think you're hearing is some belief that in anticipation of the uncertainty of knowing when this debt comes due and it's variable, that there would be a comfort potentially a comfort by more than one member of the board that we were peeling off enough funds to cover that. I get, you explained to me last night, Amy, that even if it went to 12% with the Stantec revenue projections, we could afford to pay the 12% and still stay within the model. But who the heck ever wants to pay 12%? And the second is you might be able to refi it, but then we're back to debt restructuring, paying, we're back to these scenarios where we're always refining debt. So my question is are we gonna still have an escrow defeasance fund with this refi?
We will not need to use the escrow defeasance
No,
fund,
is
but
the
we will
fund,
have.
is it still there?
We will have the ability to use it as a backstop. Yes, it's in the bond indentures.
So my question is not, if the director said, we wanted you to use an escrow type defeasance fund to put that money in so that we would maintain all our options on the variable debt as it comes due, to say, take it off the books, pay cash, whatever. Do we have that ability? Is that part of this refi? Is a description of that
Always
part of the refi?
We do have an escrow defeasance fund built in. However, it kind of works a little differently than what you're talking about. I think we always have the ability to set aside cash and make a policy or whatever we choose to do to say we're not going to spend it. Those would be your unrestricted funds that you can do whatever you want with those for any lawful purpose. So we could set some of those funds aside for a purpose like this.
I understand that we could do that in the future outside of this deal. My question is can it be part of this deal for you to get votes? If people are uncomfortable, Bob, with variable, and we want to know that we are putting it in a rainy day fund, so if the worst case scenario does come to fruition, that it could go up 8%, 9%, 5%, whatever, that we would know we could defease those with cash because we planned for it as part of this refi.
And that's something we can write into our.
I don't know, I'm
our
asking
decision
Bob,
making.
he's the expert.
Yeah, I don't think that hurts the transaction at all. We may get, certainly, whether it has to be written into the transaction or a separate policy, but we'll certainly get questions on liquidity from the rating agencies. Like I said, we will get additional surplus revenue from the restructuring. And it will build over the next, that's part of the reason we picked the 5 years as well, the 5, 7, and 10, because those revenues are gonna build, they're gonna start to build more rapidly as you get further out and your debt is restructured and you're, assuming you meet your forecasts, your margins are going to pick up. So, and I don't know, Amy, if you have the levels of cash, but we can get you the levels of cash. But we can certainly, you can certainly put something, whether it's in the financing or anywhere else, to maintain, liquidity at levels that give you comfort. Whether it's, half the 125, all of it. Again, we don't know what the rating agencies are gonna say about liquidity position. We're gonna demonstrate what.
I know, but that's why I made the suggestion at the outset that you have two things happen. That this board reconvenes after you meet with the rating agencies so that you can share that with them and get their feedback, and then we can evaluate what we think about that. That's number one. And number two, that at least 2 members of this board go on that rating agency, because it really helps to have the electeds there to understand and come back and explain to us, understanding how we sit as elected officials as opposed to professional staff. So my question is, I think it's something that's really important, and I would ask you to make this part of the deal, understanding we have to maintain liquidity in order to service the debt, but at the same time, balance our discomfort with risk. I don't know why the rating agencies wouldn't look upon it favorably that we're actually putting the money for this variable rate bonds was income due into I'm going to call it rainy day fund, or I just don't get it. I'm not the expert, but I think they would look upon it favorably because that's super responsible.
I think the strongest message to the rating agencies would be, from this board, would be if you approve the transaction. Because that's what they have warned us or told us now so far, is that we have something that, if we have something we can do, we need to
Amy,
do
I
it.
said, those were my opening comments. Now you're detracting from what I said, that's the most important thing the rating agencies want. But you've got to help us as electeds who sit on this get to a comfort level with variable notes. I'm extremely uncomfortable. So if I don't know that money is socked away, I'm not supporting the deal. But if you tell me we have variable, but we're putting the money into the rainy day fund so that we could defease it with cash, or if rates are favorable in 5 years and it's actually lower than, say, it could be lower than what the debt structure is here, we could refinance and save money. But be that as it may, I don't have that crystal ball. But what I want to know is that if the rates are off the charts or above the rate of the variable for the first 5-year tranche, that I can pay it off in cash. I want to know that. And my vote's contingent upon that being in there.
And I think you bring up a good point, Supervisor, that having the liquidity, having the cash identified is a credit strength. So, to the extent, if these bonds are used in the structure, if there's a set aside of a certain amount of cash, I would say it's probably no more than $125 million. So you always have that knowing you can take these out in full, but it's probably at a lower point than that I think we can get the rating agencies comfortable. But like I said, we should have a pretty significant balance build up over this period, which is what the refinancing accomplishes. So set aside the liquidity and say, yes, we do have market risk, but we also have the liquidity to take this out. And certainly if your investments are earning 1% or 0.5% and your bonds are going to be at 12%, you can take those bonds out. So
The last thing I want to say, Bob, when you design that, you do not get to borrow the extra money to put it into a rainy day fund. I want to make sure I'm really clear.
Oh, no. We're talking about,
We're staying
that's
within
not liquidity. That's.
What I mean is, I'm not increasing the amount of money in this deal to
Right.
be able to put it into a rainy day fund. It's within the confines of this deal. Okay.
No, I'm clear on that.
All right.
I would condemn you if you did.
You condemn me, thanks, Bob.
Director Baker.
I have a couple of questions for Amy. Amy, you said a couple of things many times here. I have two questions. Number one, why do we care if we currently use escrow defeasance funds? And number two, you talked about how this refinance meets the goals of the agency. Well, what goals does it directly conflict with?
Well, the escrow defeasance fund has been identified by the rating agencies as a problem if used on a prolonged basis. So that is one of the factors that they're looking at that would lead to our downgrade. So that's why that's important. And as far as your question about what does...
Goals.
Well, I think this helps you, this is the best option to help you achieve all of those goals that we have stated. So I'm not really sure what it does negatively for you.
Well, the goal that I'm talking about is the goal that this agency has as one of its primary goals is to make these roads free to the traveling public as soon as possible. And to me, this taking it to 2053 versus 2040 is in direct conflict with that. And I never hear that addressed. I never hear anybody speaking about that. And it seems like we should either, if we're going to directly conflict and go completely opposite to one of our primary goals, then we've either put a primary goal in there that we're going to completely disregard, or we're not going to address, or are we going to change that and throw it out? Do we have any plan for that?
No, I understand now what you're asking. Well, this agency's goal, though, has always been to complete its system. So I think it was always, I would not to say maybe right from the very, very beginning, but pretty much always the intent that we would need to refinance and extend at some point in order to achieve that goal. So yes, I think it is still to become free at some point, to pay off the debt and become free, but it is also the mission at this point in time to complete its projects, complete the system that was originally envisioned.
Can I add to that?
You know, the board's going to have to, now's not the time, but the board at some point here is going to have to address the question you're raising, because there's one goal to pay off the bonds as soon as possible, to turn them back to be free as soon as possible, the point you're making, right? On the other hand,
Absolutely.
On the other hand, the agency also has a responsibility and an interest in what rates they should charge in the intervening years to users, both in terms of how much they need to pay on an annual basis, on a trip basis, and how do they want to interrelate with the other issues affecting the county and the region. So for example, if we're trying to get more people off the 405 and the 5 to get on 73 to reduce congestion on those roads, for example, you would want to not have the highest toll rate possible on the 73. So there's issues, policy issues that you need to address. So there's things that can be done in the meantime while you're paying off the debt that affect the ability to move traffic in the intervening years that are a major policy issue that you will want to address, that conflict with the idea of paying off the bonds as quickly as possible so that the roads are free as possible. Because to pay them off as quickly as possible, you want to have the highest toll rate possible in the shortest period of time. But that's a conflict to the idea of getting as many people as possible on the roads now to relieve congestion. So we're not going to solve that issue today, but it's a policy issue that you will want to address in the future.
I hope we do.
Okay, Neil, why don't you just stay up at the podium? We need to move this along. It's already 12:20. We've got the rest of the meeting to complete, plus the San Joaquin board is waiting. We don't want to lose a quorum. Just if you can provide your recap relating to the importance of the cooperative agreement to the agency. Just give us a quick summary.
On that only, or the cooperative agreement and the refinancing?
You could come, both would be fine.
Yeah, I think it's an important time for the agency because for 3 reasons. Number one, just like a homeowner, we've got to get our financial house in order. And right now, we're having trouble not meeting our debt payments, but meeting that bond coverage ratio that our bond investors have. And so in order to remove that kind of an issue going forward, we want to lower our monthly debt payments so that we've got that thing covered and covered well. And that impacts our bond ratings and our ability to finance projects in the future, as well as the interest rate that we're going to be paying and in turn what users are going to pay in toll rates. So I think number one, we want to get our financial house in order. Number two, this provides us with the opportunity to have sufficient funds, not to do 241 South, because that's too big a project. It has to stand or fall in some way, but to do projects that are important for the agency, such as 241-91 connection, the 405-73 connection, and others. And then number three, I think the point I was just making, that if we want to be able to play as a regional partner in partnership with Caltrans and with OCTA in trying to improve mobility in this region in the short term, we need to be a lot more flexible in the way we charge our toll rates, the time of day, the amounts, etc. And in order to do that, we needed the maximum flexibility possible for you all to be making that decision on what those toll rates will be on an annual basis. And if we don't refinance, we'll have that flexibility.
All right, let's bring this back to the board for final discussion and a vote on this item. Some very important points have been made, and I do agree with Director Spitzer with regard to the Section 8 in the resolution to strike the words each standing alone. With regard to coming back to the full board for approval before we move forward, we may need to move the trigger very quickly as far as moving forward with interest rates dropping. And instead of the full board, I might suggest the financial ad hoc, which is a smaller subset, of course, of the full board.
Madam Chair, as bond counsel has pointed out, there is a provision in the Joint Powers Act that requires that a bond issuance be approved at a regular meeting of the board.
Okay.
So we want to be careful that we do this in a manner so that that's the way it is approved. And if the action that is taken subsequently is deemed an approval, that it's done at a regular meeting. 2 ways to do that. We can adjourn this meeting to a specific place and time, and that it can be a place and time at which certain board members can call in telephonically if they want to. We can arrange for that. or we could simply continue this to the next regularly scheduled meeting. That's probably too far down the road. So I would suggest if we can find a specific place and time to which to adjourn this particular meeting, and have that action take place at that time, and we comply with the joint powers act.
Okay, great, thank you. And I guess the other item would be to set aside, with the excess financial capacity from the potential refinancing, to set aside the minimum of 125 million to meet the requirements of Director Spitzer's concerns. Amy, did you have additional comments?
Can I weigh in on that one
Yes.
outstanding issue?
Yes.
We kind of have to pull the board. You all have to say something, because I don't know if you just want to vote and be on your way about it, or if you feel like I do. I mean, please, if you disagree, please, say that you do. I would like to continue the meeting to a telephonic. I also think we need some volunteers to go with the staff to the rating agencies. I know everybody doesn't, maybe they have the flexibility to go to New York next week, but we need some volunteers. And I would urge you, you have to support the deal to go, okay? I don't think you should go if you want to blow it up. But there's nothing like having the chair, Supervisor Nelson went on the 91 refi. I was unavailable, he went in my place, and he did an amazing job. It makes a big difference to the rating agencies when the electeds talk on behalf of the deal. So I would ask for those two issues to be resolved
All right.
on this issue.
Okay, very good. Okay, what is the pleasure of the board? Director Crane?
Yeah, I just want to weigh in on this. I do support the deal, so I would volunteer to go to New York. But I just wanted to ask, when you're going to New York next week to these rating agencies, didn't you say that you wanted to have a cooperative agreement signed in your hand? It makes it a lot stronger.
It's already signed.
So this is Thursday, I don't know when you're going next week, but we'd have to have a telephone conversation tomorrow. Or
That is correct, that we would need that before meeting
I
with
would
the
like to
rating
take a
agencies.
vote now to see the temperature of the board, and I'll make the motion to support this.
Well, wait, can you bifurcate it and just make so you can do it together, your preference, or in deference to those of us who want to hear the deal again as it gets closer to a deal after the rating agencies, I'd ask you to make a motion just on the cooperative agreement to give the authority to sign just
Okay.
that.
Absolutely, cooperative agreement, because that's what they need to go to New York.
Okay.
I'll second the motion.
Okay, we have a motion and a second. Okay, all in favor?
Aye.
All opposed?
Opposed?
Well, you're not going to New York.
But we need it. He helped on the 91.
Sorry, he's not going.
Madam Clerk, have you noted the votes? All right.
Okay.
All right.
And then I would support a motion to support Supervisor Spitzer about having a telephonic after or meeting to continue this to see what the rating agencies actually say.
Can I weigh in on your motion just to frame it? I want the feedback of the rating agencies, but I want to postpone the vote on the approval of what the deal is
Right,
until that meeting. So we can continue the meeting for a final vote. And then I'd also, if I could, I'd like to give some direction, because I couldn't get all of it last night. It was a big ask on my part. I'd like to see the other locally structured deals that are using variable rate notes only for Orange County. I don't care about what they do in Northern California. We don't look like they look like in Northern California. So whatever those local deals are, IWB, I just ask, provide that as quickly as possible. I'd like to bone up on that. So when I actually make my vote, can really understand whether this is some weird aberration, or if it's really an accepted investment practice.
And I'll second Todd's motion.
And I'll then I'm the maker of that, then fine.
Kevin did it so well.
Okay, is everyone clear on the motion with regard to the rating agencies? And in the next, it'll be a special board meeting that would be called. You can call in telephonically.
Madam Chair?
Yes.
We need to be very clear on this. This is not a special board meeting.
Continuation of the existing.
We are adjourning this meeting to a specific place and time. So the motion needs to include a specific place and time.
Okay, so we need to agree on a date then. All right.
And Madam Chair, while we're looking at that, could I just suggest that we approve the financial agreement that would be more successful, I think, in New York? Conceptually, we accept it, but we want to have final approval once the deal points are together. Isn't that stronger?
I would second that motion.
I think that's better, so when we go back to New York, it's not just, oh, we've continued this and there's no substantial position by the board on the financing agreement, but we're accepting it in concept with a final approval after the deal points, or we get the specific numbers. Now, I don't know, I just want some
Amy,
discussion.
what date are you meeting with the rating agency?
We are meeting with them on the 17th. However, one thing that I want to point out is that it would then take them a couple of weeks to actually turn around the rating. So we're not expecting the rating back until around the week of the 28th.
But a lot could change in the financial markets within that time frame.
Right. Madam Chair, you've got a motion and a second on the table, and now you're entertaining something else. You really need to take the action on the motion first and then debate the rest of it.
No, we can talk to the motion, can we not?
Well,
No,
discussion.
you
We can
made a second
discuss.
motion. You made a second motion.
I didn't make a second motion, I'm suggesting, I just threw that out as a
Yeah,
suggestion, I
it's not a
didn't
bad-
say,
It's not a bad thing. I
yeah.
just like to make sure we keep things in order so they're legitimate and legal.
Would the maker of the motion be willing to accept this, that we approve this in concept, coming back with final vote at our specific date to be determined, or what we determined today?
I do.
Thank you very much.
Well, one comment though. Amy, the rating agency meeting is on the 17th, and you're saying they may not be able to get back to us for a few weeks after that?
Yes. So, and actually, we're meeting with two of the rating agencies on the 17th, and we are trying to schedule the third for either a call on the 18th or possibly a meeting in person on the following Monday, whatever that is. So the two that I've spoken to, who we've scheduled meetings with, I think we can get a rating turnaround by the week of the 28th, but it does take them some time to actually go back through, rerun the numbers, everything that we provide them with. In fact, I would begin, if we got approval here today, I would begin providing them with as much information as possible now, ahead of time, so that they can start working on it. And that's still what they need, is probably the week of the 28th until they can get back to us.
Yeah, but the point of that is that you can't do a deal, if you want to do it tomorrow, you can't until this is rated anyway, right? You have to wait for the rating agency report for it, fair?
Exactly. So the earliest we'd be able to continue this item to a date certain would be after they've met, after the meetings with all the rating agencies.
Yeah, just with respect to the rating agencies, as we've said, the rating is really contingent upon executing the refinancing, creating the margins, getting back to, as Neil mentioned, meeting covenant coverage, getting the financial house in order. They're used to having boards set parameters, the deal has to produce such and such an effect or not, or be under a certain interest rate. I think what they're not used to, and what this begs the question, is why is the board reluctant to approve the restructuring when they have parameters in place? Why is the board reluctant, or what do they expect us to do? Why is there a second look after us? So it sort of begs those questions. I think you go in there with a position of more strength if you can nail down the parameters you'd like to see. It's like I said, 125 million in free cash. We have the rating, or we certainly have the ratings that we need to achieve, and we have the interest rate parameters and the like. And they've seen this transaction before, so they know what the impact is, and all three of them will downgrade by the end of the year probably if we don't get a deal done. So
Well, you need 7 votes, okay? There's 12 of us left. Right, so 6-6 is a tie. You need 7 affirmative votes. So you could test the waters and see if you have 7 affirmative votes. My belief is you don't, but I could be completely wrong.
yeah.
But, I mean, again, Bob, we've given you tentative, the motion is the approval to go forward and put a deal together. But I think the heartburn is that given the fact there could be a blending up to 500 million of variable, or a lot of variable, people may not have a comfort level with that. But now that you've offered that fund, I think
Mitigate some of it, yeah.
when you get the language, when you get the paragraphs put in place, when you get the resolution, that was an improvement today. That's why we have these public meetings. So why can't you do that? I mean, you're going to meet with the rating agencies, you said the 17th and the 18th, right?
17th is where we're working on the 18th.
Fine, so instead of having a meeting on the 28th, that takes them 2 weeks to issue their report, why don't I suggest that we continue this meeting to, like the 22nd, 21, like, say that following, maybe that weekend on a Saturday or Monday or Tuesday, and then you can get our input before they write the report.
Well, how does that help them?
Well, in order for them to write the report, aren't they going to want to know basically what we're going to do? It's a chicken and egg thing.
Yeah, I mean, I think if there's action not to, I can't speak for their schedule, but I would assume it'd be accelerated if there's not approval of the transaction. Not a delay, but a no vote. But we don't know what they're gonna ask us for, and certainly if they ask us for something that no one has the authority to do, and yet come back to the board, we'd have to do that. And the ratings would be contingent on that, and we need the ratings in order to sell the bonds. So there is sort of an internal policing just by the dependence on the rating agencies. But I don't disagree that we ought to go in, we can go in with a little bit more strength, you know, with liquidity and the like, as I said, to prove the liquidity, which I think they're gonna ask for anyway. And if there is something they come back with that you know, we have to come back to the board on, we've got to do that anyway. If they're not, you know, it's probably more advantageous, given where this market is and how volatile it's been, to just start going.
Move forward.
Yeah.
Madam Chairman, we have our legal counsel here. What is the verbiage we can use to say we ratify, we approve this in concept, but we will have a final ratification of terms, is there a way to do it to give strength to our staff to go back to New York? I mean, what do we need to be saying, but also protect our right to ratify the final agreement?
I think the question really is more what's going to play with the rating agency.
Yeah.
You know,
Well, that's what I'm asking.
Madam Chair.
Okay, we have just some more questions. Director Bates?
What I'm hearing to be the huge reluctance after a lengthy discussion is really with regards to the variable rate. And it would seem to me the simplest approach would be to go ahead and put that into the deal right now with the motion to approve contingent upon a fund available for the fifth year of $125 million. They will know that's our concern, and we want it, we set it aside, and we have it set aside. So we've kind of gotten over the hump if that's the only concern, because that's what we've been discussing for the last.
Brian can speak to what we need in terms of specific language. Our friends at the federal government cause issues when you dedicate money to debt service. It's yield restricting and all, which now is not a problem given where rates are, but we're hopeful that we'll get a little higher investment rate. So I would suggest that you require some free cash, that there has to be some sort of minimum free cash balance, but not necessarily a dedicated fund, because that triggers tax implications. Brian, if you want to speak to that. So it'll demonstrate liquidity of the rating agencies without causing, you know.
Well, how do we say that?
That's what I'm trying to help us.
We need the specific
We
language.
need the verbiage.
Brian, I think what you would do is you create some sort of reserve policy or some sort of policy that you would at all times maintain a certain cash balance in a designated account in the agency that couldn't be used for other purposes, couldn't be used for certain purposes. We have to be careful, because if it's a dedicated fund underneath our indenture, then it does create federal tax law issues that we want to avoid.
We used to call it toll mitigation.
Yeah. But we could come up with an account. If the board gave a policy that they were to set aside $125 million, we'd figure out a way to make it work under federal tax law, as long as it's in some sort of segregated account for the agency.
So we could have something as simple as, with the restructuring taking place, that we would just also, with the restructuring, implement a reserve policy where we would set aside a minimum of $125 million.
That would be my recommendation.
Okay.
Yeah.
If you use the rate reason.
Okay, Director Crane.
Yes, I think we bounced around this for a long time, and I think if we make a motion, which I'm prepared to make, to support this, we've given them all kinds of criteria, but we've given them a parameter in which to operate. It's going to give them a lot more strength in New York with the rating agencies if they have this board's support. I don't want to go in and be wishy-washy and say, well, they're going to have another meeting after this. We have to decide if you get the rating. And these people in Wall Street are sophisticated enough that they're going to say, well, if your board doesn't support you, why am I going to stick my neck out and refine your project? So I'm going to make the motion to give them carte blanche within the parameters that we've identified to go to New York and refinance this.
I'll second that.
We have a motion and we have a second. All in favor?
Aye.
Aye. All opposed?
Opposed.
Is that for in opposition?
Can I just get clarification on the motion? So it means it's not coming back at all? We're not going to be able to confirm?
It's not continued.
Well, see, I don't like.
So you got me right? Thank you.
Well, no, I am. I know. That's what I
Well, the
would do.
reason I did it is because we have to operate from a strength position. If we just are wishy-washy about this, and we're gonna see what the rating agents say, and then we're gonna make a decision. If we don't like what they say, we're gonna not vote for it. But they're gonna say, why isn't your board supporting this? Because they need to operate from our position of strength. So I think we're binding their hands if we don't support this.
That's what I was asking. Isn't there language that we can do both? That we can have a strong message and a vote that says that we support this refinancing? We just are going to agree to relook at the final product and ratify that final product when it comes back. Can't we do both?
There's already been a motion and a vote.
And it's already passed?
Oh, it passed already?
Did it?
What's that? I didn't see it.
No, it takes 7.
Yeah.
And you had 5 no's.
But
there's
12.
there's
14 people.
There's 14, there were 14 of us
There's
here.
It
12
takes
people.
8 to pass.
8 votes, there are 14 members here.
Is there 14?
Okay.
So it passed?
So, okay. All right, and that motion passes.
Could you repeat the motion, please?
You voted on it.
Okay, we're now going to move on to Chief Executive Officer's report.
Lisa did it.
Still passing? That's right.
Good morning, Madam Chair, members of the board. I'm David Lowe, Director of Design and Construction, and I'm here to bring you a 24191 direct connector update. Next slide, please. This is a photograph with a simulated connector in the middle of the 91 from the 241. We know it's a simulation because there's no traffic on the 91 right now. Next slide. We are working with OCTA closely on developing a project delivery approach. The goal is to open the connector along with the 91 capital improvement program that they recently started their design build work on. We currently plan on using tolls as the primary funding source, but that still has yet to be determined. And key elements of that delivery approach include what the tolling policy is, the traffic operations, and along with the project, we need key Caltrans and FHWA partnerships. Next slide. Project look ahead. Here's a list of items that we see coming before the board in the next several months, including procurement and financing methods in November, an investment grade traffic and revenue study that we'll be beginning procurement on in December, and preliminary engineering and a design build contract in December as well. Looking forward to awarding a design build contractor in December of 2014, start construction in May of 2015, and opening the project in early 2017 along with the express lanes extension in Riverside County. That's fine. That's it. That's all I have.
Thank you.